presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone, and welcome to the Compak Asset Management YouTube update for October 29th, 2021. I'm Moe Ansari, President of Compak Asset Management and host of Market Wrap. You can get the daily edition of Market Wrap simply by going to the Apple Store and downloading the Apple app, which is for Market Wrap. Every day you'll get the daily edition of Market Wrap 1-hour broadcast that I do that's syndicated nationally, where you can find out what I'm thinking, great guests every day, and my technical analysis. Simply just type in Market Wrap with Moe and you can get the app. Let's go to the COVID update. This was one of the slides that I saw that surprised me, that 42% of kids age 5 to 11 are estimated to have been infected by COVID. That's since last year. I could not believe it when I saw that number. But again, kids get it. It's like the cold. It's not really, not that many people. Kids, fortunately, have not been impacted by COVID, but 42% of children already had COVID. So I think now that the vaccine is out there, it is. Some people get it, not as many kids will need to get it. But out of the 414 million doses of COVID vaccine that was administered as of December 14th through October 25th, the fatality rate is 0.0022%. So if you're vaccinated, very small chance that it will be a catastrophic event. Yes, if you get it, COVID, it's still, I heard, even if you're vaccinated for breakthrough infections, there are about, 9,000 infections. It's not that bad at all. Looking at the COVID vaccination rate, it went straight up. As soon as the CDC recommending pausing the vaccine, everybody said, uh-oh, there's something wrong. And since then, the vaccination rates have plummeted, but they've sort of stabilized about 1 million a day or right around. Now we're going down even further because a lot more people are vaccinated. But now we are getting to that herd immunity number where we have the people who are vaccinated, a lot more people are getting the boosters. We have the people who got COVID and they have the antibodies. So when you combine those numbers, we're getting to the post-COVID. It's going to be different. Post-COVID life is going to be different than the COVID life, pre-COVID, but we're going to adjust and we're learning to live with this endemic. Looking at the big news this week was the president going to Congress and saying that we have a compromise. He announced the outlines of a program, $1.8 trillion program. It is the Build Back Better America plan. And what does it include? There's a lot of stuff in there. There's about 2,400 pages. They're still working on it. The president went yesterday before he left for Rome for the G20 meeting that we've got a deal, but then they could not have a vote. What is in it? There's about $555 billion in clean energy investments for climate change. A lot of it is for to support companies for EVs, for different things as far as EVs go, cars go, and all of those kind of things. How to take coal-fired plants, convert them over to other plants and using clean energy. So a lot of money for the energy products. $400 billion for childcare and preschool. Right now, for preschool, 3 and 4-year-olds don't have support. If you make 7% of your income, median income in a state, if you will not pay more than that if this program goes through. Earned income tax credit that the Democrats put in. This was a program that was put in last year, COVID relief, and everybody has kids if you don't have kids, you still get a higher earned income credit. So that's there. There's home care for seniors of $150 billion, $150 billion for housing. Uncovered states, $130 billion for the ACA expansion, $90 billion for equity and other investments, $100 billion for immigration, higher workforce, and Medicare. It's a little bit for everyone. That's what it is. And but it's only 1.85 trillion. As you know, I talked about this number and I said 1.5 to 2 trillion. It was my number 6 months ago. We are getting right in that middle of that number at 1.85. I think this is something that the moderates and the liberals in the Democratic Party will coalesce around. They were trying to get a vote done after the president went to Congress, couldn't get it done. They were trying to schedule a vote to get the hard infrastructure bill, which is already approved, by the way, by the Senate, and this is Republicans, Democrats. But the liberals in the House are saying, no, we want the other bill, which is the $1.5 trillion bill also, and they want all the details pinned down before they vote for it. There's an election coming up next week in Virginia. It will be, I think, a wake-up call for the Democrats, where if they lose, that they will be definitely very, very concerned that their support is eroding very quickly. The liberals if they just stick with this, I think, and they do it later on next year, somewhere in the summer of next year, it will be too late. Nobody will see the benefits, and they are going to probably lose the House, the Senate, go back to the wilderness, and that will be tough for them because then they will have absolutely nothing. So do they get everything or $2 trillion? By the way, $1 trillion is a tremendous, tremendous amount of money, and they've still got $1.85 trillion. I think they will figure it out for their own survival that they have to get something done, and will get sooner or later. Looking at looking at wages and inflation, we got the PCE. It was at the highest level we've seen in the last 20, 30 years. So we're still seeing this clogged up the supply chain. This is a picture of what we're seeing in the port of Los Angeles. Boats, ships are parked all over. If you fly out of Los Angeles, you'll see all these ships lined up and nowhere to unload. They can't unload fast enough. Once they unload, they can't get the containers out of the port. So the port is clogged. They don't have enough drivers to take all the product out or enough trains. So I think it'll take a lot longer than everybody thought to get the supply chain unclogged. It might take until the middle of next year. That means inflation is going to run hotter than expected. But you know that. For the last 2 years, I've talked about that. The Fed is going to let inflation run hotter. That means prices are going up. Consumers are still willing to pay. There's so much pent-up demand and so much money saved up that the consumers are still willing to pay these higher prices. And as long as they're paying the higher prices, we are seeing profits are still going up. 82% of the companies so far that reported last quarter's earnings have beat expectations. So earnings are still holding up very well. Profits are holding up very well. And as you've heard me for the last 30 years in Market Wrap, talk about what drives the stock market. It's simple. The more money a company makes, the more valuable its stocks are. Have a good diversified portfolio. One thing you don't want to do is get greedy. That's two things that really create problems for people: fear and greed. If you keep your balance, which is hard to do when you're investing because it is money, it is an emotional subject, but trying to keep those emotions out and trying to build a conservative portfolio over a period of time is what you want to do. Looking at rising rates, people are talking next week we are going to get the taper announcement from the Fed. Probably they're going to announce that they're going to cut back on the 120 billion that they're buying every month in bonds. They're going to cut back. They're buying 80 billion right now of treasuries and 40 billion of mortgage-backed securities. They're going to cut back 10 billion of treasuries, 5 billion less of mortgage-backed securities. That per month, that's what they want to cut back. So middle of next year, they will be done with tapering. No more money being put in by the Fed. So that takes away 120 billion. But if we get the 1.2 trillion hard infrastructure and the 1.85 soft infrastructure, social infrastructure, whatever you want to call it, that's still $3 trillion. It doesn't come to the market all at once. Probably it'll be over the next 10 years, 300 billion a year. Still, tremendous amount. They're taking away monetary support, but the fiscal support is going up. And that money, as you've heard me for the last decade talk about, whenever the Fed starts printing money, it goes to two places, the stock market and the real estate market. You're going to see pullbacks, and then rates going up is not the end of the world. you can see the market goes up 82% of the time because interest rates only go up when the economy is doing well. The Fed is trying to slow down the economy. Interest rates go down when the economy is not doing well. So I think with rates initially going up is not a bad sign. But they reach a point where they choke off the economy, but we haven't even seen rates go up. All the Fed is talking about is cutting back on tapering. Looking at the overall, technology is expensive. I think at this point, this is when it was the most expensive, 1999, but the PE ratios are pretty expensive right now in technology. I think as we get to post-COVID, we see a breakout in the Russell Small Cap Index. That's small businesses, the restaurants, the travel industry, the leisure industry. That comes back. But we want to get past COVID. And I'm looking at the charts to give me the all-clear signal. I'll take a look at the Russell in a second, and I'll show you the chart. Looking at the charts, it looks like we've got an extension of wave 5. This was looking like a top for wave 5, and this was the ABC. This is a daily S&P chart. You can see that it is looking like an extension, wave 5, and the target, first target, 46.75. Today we closed at 46.05, new all-time high. I know people get upset when I say that on the radio broadcast, but it's exciting. Today was the 59th new high this year for the S&P. So if you're waiting for the world to end, don't. Be in the market. Have the right allocation. Have the right mix of assets. I talked about that, how we can find the right mix with your emotional mix. If you're nervous with the market, we can dial it down. We can find the right mix where it has the right balance. We'll show you, okay, if you have this portfolio, the market goes down this much, this is how much you lose. If you have this portfolio, market goes up, this is what you make. We can adjust that. We can throttle back up and down, but being invested is how you create wealth. 10 years ago, you heard me say, cash is trash. And all it does is stink at this point. Anybody who's sitting, especially with inflation going up, that is going to eat in cash even more. So you will have to find ways to make your money grow if you want to just keep and buying the same things you're buying right now. Because inflation goes up, prices go up, your investments to go up, you get less and less. So you want to make sure we have the right mix of assets. So 46.75, support right now is at 44.59, right around the 200-day moving average. Then we have some support right here, which is the low that we made last month at 42.78 or beginning of this month, and then the 200-day moving average at 42.10. Looking at the weekly chart where each one of these lines is 1 week of trading going back to about 2017 right here is 2017, this is 2018, this is 2019, 2020, and 2021 is where we are right now. So looking at all these years, you can see that we have made 46.50 is the first target on this upside, and then we get higher targets for the S&P once we get above 46.50, 46.75. But this is wave 3. Somewhere down the road, we are going to get a fourth wave pullback, and then we start wave 5. 44.20 is for support, then 41.28 on the weeklies. Looking at the daily Nasdaq chart, each one of these lines is 1 day of trading, vertical lines that you see right here. Each one of these green and red lines is 1 day. You can see that we're starting to make a new high, a new all-time high today on a closing basis, closing at 15.5. Support resistance now, Fibonacci target, because at 15.738 is 15.750, and then 16,050 is the next target for that. Support now 15.5, which is the 50-day, 15,000, and then the 200-day at 14,150. That's how I'm looking at it right now. November, remember, is usually the strongest seasonal time frame for the market. Usually we have the Santa Claus rally, which starts in November. But October was great for the markets. I mean, S&P was up 6.9%. The Nasdaq was up about 7.5%. So if you're in the markets, you're doing well. You have the right mix. Yes, it got a little wobbly in September, but that was the time to a little prune your portfolio and pick the things you want to buy in the market. Weekly charts, 16.4 becomes the target for the third wave. You saw these dots that I talked about, that the market was below it. Once it gets below it, usually 3 or 4 weeks, well, we were About 4 weeks on the downside, the market is below the dots, but now the dots again have fallen to the downside. Usually when they fall to the downside, we can get about 10, 15 weeks on the upside in the market. And that's what I'm looking for the next rally to continue. What is going to spark the rally? I think the taper will be behind us. The Fed will announce it next week. And if the market doesn't go down a lot, people will look around and say, oh, well, market is not crashing. It's okay. Interest rates going up a little bit is okay. And then if we get the 3 trillion, that will definitely be a nice Christmas. Looking at gold, very disappointing today, back below the 200-day moving average. I know, as you've heard me say, gold, I haven't been in gold for the last 2 or 3 years or 4 years because can't get out of its own way. Stuck right here in this range, 1720 is support. If we break 1720, 1675 is the triple bottom that we've made this year. A break below these levels, and then the market really is in trouble. On the upside, if we can get above the 200-day, which is about 1795 today, we closed today at 1785. So if we can close above this and get some momentum, 1840, 1875 could become some of the targets. But I want to see some strength. With rates moving higher, it is difficult for gold to go up. Gold doesn't give you any interest. All you do is get appreciation. And when interest rates go up, bonds compete with gold for safety. People say, look, I'm getting 2-3% here. Maybe I'd rather buy bonds. Looking at the Russell small cap, these are the lines that are drawn. Last couple of weeks, this side connected this high to this high, and this was a resistance. Finally, we broke out above it this week. Looks like we're holding up. We got to 2321, came back down to about 2300, and now we're back closing at 2297, right about 2300. But we need to get above these highs, all these highs that we've made, which is 2360. If we can get above 2360, to me, that'll show you that the small cap is coming back, that we're putting COVID behind us. We've learned to live with it. And that, I think, will be the sign that the leisure industry, the travel industry, and that's where we'll see some of these small caps continue. It is starting to show signs of life. Hopefully we can continue. If we get above 2360, then we can get much higher targets for the Russell small cap. I wouldn't be surprised to see the Russell. You have to be patient. Again, it'll take time for everybody to learn to live with this endemic. It's not a pandemic anymore. It's an endemic, so it'll take some time. Interest rates, yeah, they're going higher. This was, my target was 1.8. 1.85 is this, and then 2%. This is the eventual target, 1.85 to about 1.95 is, today we closed at 1.55, so 0.5% higher that we could get to in the interest rate. This is yield. This is how much interest. It's 1.55 on the 10-year Treasury. I think rates are going to drift higher as the Fed pulls back on the tapering, but I don't think it's going to have a major impact on the stock market. It might cool down the real estate market, which has gotten way ahead. It's pulled, I believe, some of the appreciation forward for the next couple of years. We might plateau or even see prices where they've gone up too much come back down a little bit, but it'll settle down, the real estate market if rates go up, because prices have gone up so much. Only reason people can buy because the rates are so low, the payments are low. But the prices have gone up and the rates go up, the payments are going to go up, and the affordability will start becoming an issue in the real estate market. I think it's just pulled forward the appreciation for the next couple of years. I still feel that the real estate market is on solid footing. I don't see a crash, but I've seen the easy money has already been made. Don't forget to subscribe and like this broadcast. Just click on both of them so whenever I do an update, you can get notified and you know that there's a new update there. I hope you have a wonderful, wonderful weekend. I'm Moe Ansari. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.